Again, I don't want to overstate the degree to which the Fed's interests are not aligned with the federal government's, but they are controlled by different groups of people. And so it's not literally impossible that the Fed would just refrain from intervening if the Treasury got into a pinch. Okay? And it's kind of crazy that even as these debt levels tick up and up and up as far as the eye can see, that certain analysts are just flatly saying that, no, this is literally impossible, that the Treasury could default because the Fed can just create dollars. Okay, beyond all that though, besides just the split loyalties and coalitions of people and the interest and, maybe the private bankers would welcome a default. Maybe they would do better rather than debasing the currency and all that stuff. It's possible even the unified will of the federal apparatus could decide in a crunch that at least a partial default is the lesser of two evils.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. This episode, I am going solo, and at viewer request, because I'm nothing if not a man of the people, I am going to cover the recent downgrade of US sovereign debt by Moody's. So specifically, I'm reading here from a Reuters column from May 17th, 2025. The headline is, Moody's cuts America's pristine credit rating citing rising debt. So just to give you folks an outline, what I'm going to do is give you the quick facts, show you some charts and things about the U.S. debt position, just to give you more context for Moody's decision. And then the last thing I'll do is go through the objection from some quarters when this downgrade occurred, saying, what are you talking about? You can't treat the U.S. government of all entities as if it's like some private company issuing bonds. No, the U.S. government can guarantee that it will pay its obligations because it is the legal issuer of U.S. dollars. So there's no possibility that they'll ever default or that they would need to default if they do it, or just because they choose to for some weird reason. And so the U.S. government, almost by definition, these people argue, should have a AAA rating because it's the safest asset imaginable, U.S. Treasuries, or dollars for you, I guess you could say. So I'll address that argument as the final plank in this episode. Okay, but back to the Reuters article, just so you know what happened. So back May 17th, the thing I'm reading is May 17th, but on May 16th, this is when it happened. Moody's downgraded the U.S. sovereign credit rating on Friday due to concern about the nation's growing $36 trillion debt pile, in a move that could complicate President Donald Trump's efforts to cut taxes and send ripples through global markets. Okay, Moody's first gave the United States its pristine AAA rating in 1919 and is the last of the three major credit agencies to downgrade it. Okay, so that's important. This stuff happened in steps, and also Moody's is not the first agency to do this. Okay, so the article goes on to say, back in 2023, Moody's made a move. It kept the AAA rating, but it downgraded the outlook on the sovereign. Okay, so right now the outlook is AA1, which is one notch below AAA in Moody's framework, but the outlook is stable. Whereas back in 2023, it had I forget what the term they use is, like a negative outlook. So in other words, back in 2023, they were planting the seed, saying, "Okay, we're still saying it's AAA, but we're really watching it. We're not sure it's going to stay AAA." And then now they pulled the trigger and said, "Yep, what we told you back in 2023, our suspicions have been confirmed. We've got more information. We've seen things. And now we're going to downgrade it to AA1, which is one notch lower than AAA. But now we're stable. In other words, we think it should stay at AA1 for the foreseeable future." Right? So that's how these things work. And then also, as I alluded to, Standard & Poor's. So the three major ratings agencies are Moody's, Fitch, and Standard & Poor's. And Standard & Poor's back in 2011, after that debt crisis, reduced its rating of U.S. sovereign debt down one notch from the highest possible rating. And then Fitch did so in 2023. Okay. Big picture, I'm sure most listeners of the InFi podcast know this, but just in case some of you are young people trying to learn how the world works, the function of these rating agencies is to provide guidance to investors. Right? So if you're looking at buying bonds, it's important not just to see what is the yield to maturity, like what's the interest rate I'm going to earn on it, but also you want to know what's the likelihood that the issuer is going to have a partial or a complete default, right? So just because you own a piece of paper that's an IOU from some company or government saying, we're going to pay you whatever, $1,000 on this date in the future, they might not actually do that. And so your evaluation of a portfolio of bonds has to take into account the riskiness of the loan besides just the promised interest rate. And so the function of these ratings agencies is to give guidance because they have a bunch of analysts who look at these things that you can see how if you're buying corporate bonds and you don't know that much about them, that, it helps to have these analysts on the case and they give you their reports, blah, 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 and they have their ratings. So the point is the US federal government also issues bonds. They're called Treasury securities. And they historically had the highest possible rating from all the agencies. But then more recently, starting with the fight over raising the debt ceiling, that's when these main ratings agencies started to downgrade the debt. So even on that example with the debt ceiling one, the question wasn't, does the US federal government possess the ability to fulfill its contractual obligations for bondholders, people owning treasury securities? There, they were just saying, given the political dysfunction in Washington when Congress authorizes spending, but all the spending originates in the legislative branch, but then in taxation, so that's implicitly handing over the fiscal position to the executive branch. But then if they refuse to raise the statutory debt ceiling and say, yeah, we're telling you to spend this many $1 trillion above what we're authorizing you to tax, but we're not allowing the Treasury to issue more debt, well, then what the heck is the executive branch supposed to do? All right, so that's the issue, or one of the issues. And so every time the debt ceiling approaches, there's a big fight in recent decades on Capitol Hill about that stuff. And, typically the budget hawk Republicans dig their heels if they were only going to authorize an increase in the debt ceiling if we get what we want. And the crisis looms because, oh, geez, if we can't borrow more, then how are we supposed to roll over the existing debt and pay the bondholders and so forth? Okay, so that's the issue. That was one of the reasons early on was the Standard & Poor. They downgraded them because they were just saying this is a dysfunctional process. Okay, so let me read something here. So in this Reuters piece, I'll just do this quick observation here, also said, Stephen Moore, former senior economic advisor to Trump and an economist at the Heritage Foundation, called the move, quote, outrageous. Quote, if a U.S.-backed government bond isn't AAA asset, then what is, he told Reuters. Okay. And there have been some that were accusing Moody's of being political with this because they were saying, oh, now you're downgrading the U.S. debt, but you didn't in the latter years of the Biden administration. So you didn't see it. You weren't worried about the rising deficits 2 or 1 year ago, but now you are, right? I am not denying that there could be political reasons for the timing of this particular action by Moody's. But what I do want to say is I find Stephen Moore's outrage also partisan. So let me read something. This is from December 2014. It says, when I first arrived in Washington in the early 80s, the debt was roughly $2 trillion. This week, 30 years and 5 presidents later, the debt for the first time exceeded $18 trillion. We've been in the red in all but 4 of the last 40 years. Why worry? We owe it to ourselves, we're told. The mighty American economy is big enough to absorb it. This country was built on debt. There's no better time to borrow than when interest rates are at 40-year lows. There's some truth in all these claims, but my view is that the government debt isn't inherently evil. He gives some reasons why. But what we bought with most of our debt in the last 2 decades has been a bigger, more expansive welfare state. Obama called his spend and borrow policies a stimulus. Really? What do we have to show for Obama's debt? Solyndra, 46 million people on food stamps, the Obamacare debacle, et cetera, et cetera. This is one of only 2 times in American history that we've opened up the floodgates on borrowing, even as we have severely slashed the military budget. Here's the biggest worry about an $18 trillion debt. What happens if and when interest rates start to drift back upward? Answer, that's the economic equivalent of the nuclear option. Each 1 percentage point rise in the interest rate caused the U.S. deficit to rise by more than $1 trillion over 10 years. If that happens, the debt servicing costs grow astronomically and interest payments would become the biggest expense item in the budget. We start to pay more and more taxes just to finance past borrowing. This is what happened in Detroit. How that turned out. Maybe this debt bubble won't burst. Let's pray that it doesn't. But if it does, the 2008-09 real estate crash could look like a picnic by comparison. Okay. The politicians think they're pulling a fast one here, but the vast majority of Americans feel in their gut that the economy is headed in the wrong direction, in no small part because of this debt time bomb. It explains why Barack Obama's policies were so thoroughly routed during November's midterm elections. A great nation doesn't ring up unpaid bills month after month, year after year, decade after decade. The basic common sense of Americans tells us that you don't borrow your way to prosperity. Oh, and we're still borrowing $500 billion a year, so the debt will likely hit $20 trillion sometime before 2018. Have a nice day. All right. As I'm sure you gathered, what I just read to you was from Stephen Moore back in December of 2014. And now the debt is at $36 trillion. And his warning that if we keep this up, the interest expense will be the biggest item in the budget. That's now come true. Okay. So when Stephen Moore now says this is outrageous, if the U.S. government isn't AAA, who is? I mean, it's not literally a contradiction, but I think Stephen Moore from 2014 complaining about Obama's fiscal policies could explain to Stephen Moore today why, even though Trump's in the White House and Republicans control Congress, that, yeah, things aren't good since the debt is much higher now than it was back then. Okay, let me show you folks. Actually, I wanted to read, besides just the news articles, I went to Moody's itself. Let's just hear in their own words, right? So they put out, I don't know, ratings news. I don't know if press release is the right word, but they issued this. So again, this is on May 16th. This is from Moody's itself. If you go to their website, the title is Moody's Ratings Downgrades United States Ratings to AA1 from AAA, changes outlook to stable. Okay, I won't read the whole thing, but I'll just read you some of the excerpts here. This one-notch downgrade on our 21-notch rating scale reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similarly rated sovereigns. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. Over the next decade, we expect larger deficits as entitlement spending rises, while government revenue remains broadly flat. In turn, persistent large fiscal deficits will drive the government's debt and interest burden higher. The U.S. fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. And then, yeah, they get more specific. So let me turn now to the Congressional Budget Office's most recent long-term budget outlook. So here's an interesting pair of charts. All right, so that top one is showing federal debt held by the public. The held by the public part means like some of the outstanding gross federal debt is technically owned by like the Social Security Administration. That's like what they call the trust, not the trust fund. Yes, Social Security. Yeah. And so that's out, right? It's like one arm of the government owes money to the other arm, so they don't include that. This held by the public means it's Treasury securities held by entities outside the formal government itself. However, just to be clear, if the Federal Reserve buys Treasury debt and puts it on its balance sheet, that is included in this number, right? Because the Fed is considered independent in accounting terms from the federal government for these purposes. Okay, so you can see where that dotted line is. That's where we are right now. So everything to the right of that's projected. You can see we're just now flirting with the level of the debt relative to the size of the economy. So it's the percentage of GDP that we experienced at the peak of World War II. And as the chart shows, it's projected to just keep going higher. And the thing to point out is during World War II, there was a pretty big emergency. There was a one-shot reason, you can agree with the decision or not, that the U.S. federal government engaged in such massive deficit spending, where deficits at that time, as that bottom chart shows, were upwards of the high 20s, even hitting 30% of GDP at the peak. Okay? So because of that massive surge in deficit spending, that's what pumped the total debt way up. But then going forward, there actually were a brief couple years where they literally ran a budget surplus. In most of the 50s and 60s, they actually did have a slight budget deficit, but it was pretty low. And so the overall growth of the economy was higher than the growth of the official outstanding stock of debt. And so that's why the debt divided by GDP, that ratio fell over time. Okay. And then you see since the mid 2000s, particularly accelerated during the financial crisis in its wake, and then after COVID. But now you see it's just going up as far as the eye can see. Okay, so when people sometimes argue that, oh yeah, the debt to GDP ratio is high, don't get me wrong, but I mean, it was this high after World War II, and nobody looks back on the 50s and 60s as being an economic disaster zone for the US. Yeah, that's true, but that's also because deficit spending went from 30% of the economy down to basically zero right away when the war ended. Okay, so because that massive surge in debt at the time in the late 40s was due to a one-off crisis, that's why the US could then grow out of it, because spending went back to more normal levels and we just outgrew the debt. We can't do that now. The reason the debt is so high, let's put it this way, it's not that, oh, because of COVID, they did this one-shot massive thing and that's what made the debt balloon, but now we're back to normal and we can let it gently shrink over time relative to the size of the economy. That doesn't work. The reason going forward the debt just keeps getting bigger and bigger is because of underlying demographics, so-called unfunded liabilities, right? So you may have heard estimates, and with these things, it depends how long the time horizon that you pick, what discount rate you use, other assumptions you make about economic growth, interest rates, blah, 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 the influx of immigrants who are then going to work and pay taxes. But these projections about the insolvency of and quantifying the degree of insolvency of Social Security and Medicare, you may have heard those numbers. They're in the many trillions of dollars underwater. Okay. That's not officially included in the figures when people talk about what's the federal debt right now. The fact that like over the next 75 years, an actuarial analysis will show Social Security and Medicare might be underwater by $50 trillion in present value terms. That's not included when they say what's the federal debt right now. But over time, as those outgoing checks to Medicare and Social Security recipients exceed what workers are paying into the system. And that's true right now, by the way. That's not some looming thing that may happen if we don't get our ducks in a row. It has been the case for several years at this point that the outgoing checks to Social Security beneficiaries take more money than what people are paying in terms of the deductions on their paycheck to Social Security right now. Okay, so already the Social Security program is a net drag on the rest of the government's finances. It's eating into the so-called trust fund. Okay. So the point is, over the coming decades, that looming unfunded liability that's in the many, many trillions of dollars gets converted into official federal government debt when they have to borrow money to, in part, pay to account for that mismatch, that the Social Security program is not taking enough in worker, quote, contributions that it has to send out in checks to current beneficiaries. So the government has to borrow to fund that as the payments come due. And so I'm saying that's partly how you understand why is it that these CBO projections show the federal debt ballooning, even though it's not like they're building in here assumptions about a massive economic crisis. They're not predicting, oh, there's going to be another pandemic every 3 years. And that's why, no. This is just normal return to standard economic growth and so on. And you can see on that bottom chart, which focuses on the deficit and its components, the pink region is the expansion of net interest outlays. So you can see how much of the total deficit in the coming decades consists just of the fact that we have to spend more and more just on interest payments on the existing debt, as opposed to in World War II, yeah, the government borrowed 30% of GDP in one of the years, but they used the money to go buy tanks and things. It wasn't that they had to borrow that much just to pay interest on the pre-existing level of debt. Whereas that is the case going forward, that the government's going to have to keep borrowing more and more money just to pay the interest coming due on the money they borrowed earlier. And so that's the kind of scenario that is alarming analysts like at the ratings agencies who are looking at this and saying, there's no clean way out of this. There's no way the politicians are going to come in and fix this until a crisis hits. People have been warning about this literally for decades, and they don't do it. They just keep kicking the can down, and their problem just keeps getting worse. And in fact, you can see the growth has gotten much worse in recent decades. It's sort of like the genie was let out of the bottle. This is me now talking. I'm not saying that any of these Moody's analysts and others say this, but I'm talking here saying, I think something quite decisive happened, and this is partly my fault. That's why I'm so strident on this point, is because I'm admitting that I contributed to it. That when the Obama administration started engaging in massive deficit spending and the Federal Reserve opened the floodgates with so-called quantitative easing, they slashed interest rates down to basically zero, and then just engaged in unprecedented levels of open market operations, creating base money to take treasuries and mortgage-backed securities out of their balance sheet. A lot of people, including me, in like the late 2008 throughout 2009 period, were saying, whoa, this is bad. This is going to lead to a massive problem. You're going to see, rapid consumer price inflation. You may see rising interest rates, things like that. And that didn't happen. And so, unfortunately, I think that taught policymakers and people in the financial sector around the world that, oh, actually, these warnings that we've been getting from the fuddy-duddy economists and budget hawks are just nonsense. It's voodoo. Well, yeah, maybe it's true that a private corporation can't conduct its affairs the way Washington's been doing, but apparently somebody that can issue a fiat currency can. And I think that was a dangerous lesson to learn because it wasn't correct. So again, the specific short-term warnings that certain people, including myself, gave were obviously wrong. Consumer price inflation did not rise the way I thought it was going to in 2010, 2011. But the flip side happened when going into COVID, there were plenty of economists on the other side who were saying, yeah, we don't need to worry about price inflation. That's not the issue right now. And then they kept continually being surprised by how high consumer price inflation went in 2022, 2023. Okay, so both sides here made symmetric mistakes in terms of their short-term predictions. And I think, like I say, long-term, what happened was, I believe that reduced the willingness of certain political officials to stand firm amidst demands for higher spending. That, hey, the previous administration added trillions of dollars to the debt and nothing blew up. Well, why don't we do the same thing to our constituents and reward our, the people we want to reward with massive contracts and so on. And yeah, cutting spending is unpopular. It's painful. Why would we do that? Just let the good times roll. We'll grow out of this. Okay. Let me show you one last thing here from this CBO report. This table is the long-term economic outlook by calendar year, and you can see it's got a bunch of different things. The current amount, the actual 2024 column, but then showing like 2035, 2045, and 2055. And one of the line items here is our interest rates at the bottom. And you can see right now it's at 4.2. They're projecting for the rest of this year it's going to be 4.1, and then it's slightly lower, 3.8, 3.7, 3.8 over the next 30 years. And you can see that long-term trend is identical to the average level from 1995 to 2024, which is that first column. So what's my point here? That was the 10-year Treasury, and then the bottom row is the average of all federal debt held by the public. And you can see it's a similar pattern that they end up showing the long-term average interest rate on all outstanding government debt they think is going to be a little bit lower, 3.6% as opposed to 3.8% than it was during the average from 1995 to 2024. All right, so I just want to clarify here, these assumptions that those earlier charts I showed you from the CBO about how the debt to GDP just keeps going up as far as the eye can see and how net interest payments just become a huge part of the overall federal budget and a big component of the deficit, if you want to view it that way. That's not because they're assuming some debt spiral. They're not assuming that, as the U.S. government becomes a riskier bet as far as investors are concerned, well, then that means they charge a higher interest rate, and then, that makes it harder to service the debt, so then the government's fiscal position's worse, so they got to borrow more, and then it's just a downward spiral where rates keep going up and up and up. That's not built into these assumptions. So that kind of a debt spiral is not what's driving that CBO chart. And also, like I'm telling you, they're not building in that there's going to be some global recession 5 years from now, and the tax revenues are going to cut. These are very standard baseline, long-run equilibrium projections because they don't want to be political. They want to put in stuff that would be controversial. That's reflecting largely just the fact that interest rates have returned to historic norms. So they're not building in that interest rates are going to keep going up. They're just showing that interest rates, really what it is interest rates were abnormally low from 2008 to whatever, 2019. All right, that's the thing that was weird. And that's why the massive deficits of the Obama and then the first Trump and then Biden, that's why that didn't show up as a huge component of the federal budget in terms of the ongoing interest outlays, is because, yeah, they were running up the debt at the same time that interest rates, especially on government debt, dropped to basically zero. So the analogy I've used before, it's like if you keep getting offers in the mail from credit card companies giving you an introductory 0% APR grace period where, for the first 6 months, 0% APR on your balance transfers and purchases, blah, blah, blah. And so you might keep rolling your debts over out of these new cards and going out and buying flat screen TVs and things, and it doesn't pinch. You're able to pay the rest of your bills every month. You don't have to go get a second job. And it seems like, hey, this is great. I'm getting all this extra, all these goodies. And yeah, I have this growing debt that I keep checking my statements from the credit card companies. But as long as those new offers keep coming in, I just roll it over. Doesn't really hurt. But that all comes crashing down once those introductory 0% APR offers stop. And then that's when the pinch hits. So that's what's going on here. Or that's partly what's going on. It's that interest rates are rising from their rock bottom, ridiculously, abnormally low levels back to more historical ones. Okay. Even there, to say like the long-term rate on federal debt is 3.6%, that's still quite modest. And yet those charts I showed you assume that. So that's maybe another way of understanding why Moody's and the other two agencies slightly downgraded the security or the creditworthiness of the U.S. federal government on its unsecured debt, because they're looking at that and realizing if everything just goes smoothly, there's this gradual mushrooming of the federal debt relative to its revenue sources. What happens if there is a little hiccup and investors do get spooked and rates rise, even if it just kind of a temporary thing, that could, it's in itself trigger a massive problem. Okay. Let alone if there is an economic crash over the next 30 years, that would also make the situation much worse than what that chart showed. And what that chart showed was not good. Okay. So those are some of the fundamentals underlying these concerns over the budget. Let me now address the arguments from some. So, for example, I saw some people on Twitter, they were sharing, the Norman Rockwell, the meme of the Norman Rockwell photo where the one guy's standing up like at the town hall and advances some unorthodox position. So some people were sharing that when this Moody's announcement happened, saying, if the U.S. government isn't AAA, then no entity should be, or something like that, right? Sort of echoing what Stephen Moore said. And the way I responded was to say, okay, I agree. The fact that the U.S. government can borrow in dollars and can issue legal tender U.S. dollars, and that's the global reserve currency, those are points in its favor. But when you say, so I can't imagine an entity that's more creditworthy than the U.S. Treasury, sure, but you can split it up and say the U.S. Treasury with a 10% debt to GDP ratio or the U.S. Treasury with a 300% debt to GDP ratio. Are they equally creditworthy? And I think you can see when you do it like that, no. And so just the fact that it's the U.S. government doesn't mean by definition it's AAA. If it was AAA 10 years ago, it's not obvious that it should still be AAA today, because clearly the U.S. Treasury is in a worse spot fiscally now than it was 10 years ago. Okay, so another thing too that I think there was some misconception, the agencies are being consistent in this respect. All right, so just on a lark, I went up and looked up Japan. So here, let me show you, this is like an aggregator site that I spot checked some of the specifics so that it seems like it's accurate. In other words, I didn't catch it summarizing anything in these tables that didn't correspond to what the agencies themselves that I could independently verify said. So here we have the ratings from various agencies regarding the U.S. And so it showed this top line. Moody's rated it at AA1 back in May 2025. And then you can see Scope also has not top-notch ratings. Fitch has it at AA plus. So you can see Moody's, it was still AAA, but it was a negative outlook back in November of 2023. Okay. And then, And so on a lark, I went and looked up what's Japan's credit rating. Okay. And so you can see, according to this aggregator site, Fitch in January of 2025 only gave Japan an A rating, and Moody's, as of November of 2023, only gave it an A1 rating. Okay. So it's not that they have something out for the US in particular, that you can see they're being consistent, that the Japanese government is in many respects very dependable and so on, but they also have a very high debt to GDP ratio. And so that's why the ratings agencies are not giving them a pristine rating. All right, because there is a possibility they will default. Okay, so coming now to that central question, how could it possibly be that they will default? And to be clear, in case people are getting confused, what we're talking about is there a possibility that the US Treasury, like, you own a bond that says the US Treasury owes you $1,000 on this date. And is it possible that that date arrives and the US government doesn't give you $1,000? They either give you less, or they maybe just delay and say, we can't give it to you right now, but hang on and we'll let the interest accrue. Or maybe they'll just give you a partial payment. So that's all we got. That's the issue, is that could there be some sort of credit event where there's like a restructuring, the way this happens in the private sector all the time. Even large reputable companies that have issued a lot of debt, they could get into financial difficulty, particularly like if the economy changes and they thought they had access to all sorts of financing that dries up, and then they could be caught with their pants down and owe people money, and we can't pay you. And so they got to work something out. So again, it's not usually that they just say, I guess you shouldn't have lent us money, and then they get nothing. It's usually some drawn out process where you're not getting paid back in a timely manner, and or what you end up getting was not the full amount that you originally thought you were getting. Okay. And so that's what the function of these ratings agencies is in this context, is to give investors guidance as to what's the likelihood of that happening. Okay. So in that context, then the natural, understandable question is, how could anybody think there's any scenario in which the US Treasury wouldn't honor its dollar obligations? Because with a private company, the issue is they can't print money. So yes, if they get caught in a pinch and they owe somebody US dollars, they can say, we can't come up with it. We can't rob banks, so we're stuck. Whereas the Treasury could. The US government, at least if you include the Fed as part of it, has the ability to print dollars. And so why can't they just do that? So already I just gave you one hint. Strictly speaking, the way our system works right now, at least nominally, the Federal Reserve is independent from the federal government. Okay. And we can argue in this episode here of InFi, I'm not going to get into the weeds of the nuances involved. There's points you can make on either side of it, but put it to you this way: the Federal Reserve is not an agency of the federal government the same way that the EPA or the Department of Homeland Security are. Okay. On the other hand, the Federal Reserve is intimately connected to the government in a way that like Walmart isn't. Okay. Among other things, the president appoints the chair, the head of the Fed, and so forth. Okay. So the president doesn't nominate and get confirmed the head of Walmart. That's not how that works. All right. So and technically the Federal Reserve is what you might call is a quasi-independent entity, that it's technically owned by private banks. All right. I don't know if you folks know that, or many of you know that. So legally speaking, the banks, private commercial banks, own shares of stock in the Federal Reserve. But again, they don't get to just pick their chair the way the shareholders in a private company do. And so there is this overlap. And then the things that the Fed can do, it's special powers that make it more powerful than some random commercial bank, are granted by explicit authorization from the federal government. And so technically Congress could revoke the Fed's powers if it wanted to. So that's the weird sense in which the Fed is independent, but not really of the federal government. Okay. But again, it's not like pharmaceutical companies literally own shares of stock in the FDA. There's plenty of evidence that the big pharmaceutical companies have an undue influence on decisions that the FDA makes, but the process is a little more opaque. Like, what FDA officials, when they retire, might get nice plush consulting contracts with big pharma. That it's not just that the pharma companies literally own stock in the FDA, but the banks literally own stock in the Fed. Okay. So having gone through all that, you can see that's one avenue where it's not so straightforward just to say, oh yeah, if the Treasury owed $100 billion and the tax receipts weren't there to cover it, and they went to the markets and tried to borrow the money and the demand for new treasuries wasn't there, then they could just turn to the Fed and the Fed would print the money. Well, no. I mean, the Fed would have to agree to it. Maybe they wouldn't agree, for one thing, right? And again, the way the system is right now, the Treasury could not just pick up the phone and compel the Fed to print money. Also, as I was just walking through that, we hit another complication. Right now, even if the Fed wanted to be accommodating, they don't literally create new dollars to fund government spending directly. There still has to be the issuance of new Treasury debt into the private sector, and then the Fed buys it from like the primary dealers. The Fed right now cannot directly just lend money to the Treasury. Or put the other way, if the Treasury's short and needs to finance $10 billion of deficit spending, they can't just issue $10 billion in new bonds and sell it directly to the Fed, and then the Fed just credits the Treasury's account by $10 billion that it can go spend. There has to be a step in between there, just by law. Okay? So they could change all that if they wanted to, but my point is, the way the machinery is set up right now, it is not simply somebody presses a button and that's how you finance deficit spending. That there's a lot of moving parts, and you can imagine, especially like in a financial crisis where things are collapsing and liquidity is drying up in various sectors, you could imagine a scenario where even though on paper you've got the Federal Reserve that has the ability to create money and the Treasury trying to issue bonds that ultimately will find their way out of the balance sheet of the Fed, things could get in the way, including the will of the people running the Fed. They might just say, no, we don't want to. We're not obligated to bail you out. That could happen. Okay? I mean, just look at Trump and Powell, and they're fighting right now. So again, I don't want to overstate the degree to which the Fed's interests are not aligned with the federal government's, but they are controlled by different groups of people. And so it's not literally impossible that the Fed would just refrain from intervening if the Treasury got into a pinch. Okay. And it's kind of crazy that even as these debt levels tick up and up and up as far as the eye can see, that certain analysts are just flatly saying that, no, this is literally impossible, that the Treasury could default because the Fed can just create dollars. Okay, beyond all that though, besides just the split loyalties and coalitions of people and the interests and, maybe the private bankers would welcome a default. Maybe they would do better rather than debasing the currency and all that stuff. It's possible even the unified will of the federal apparatus could decide in a crunch that at least a partial default is the lesser of two evils than just pure outright monetization. And the way to understand that is to take a step back and say, given that right now the US government, if we include the Fed as part of it and just assume it's a consolidated entity, given that they can cover their debts, or their deficits, I should say, by creating new money, then why do they borrow in the first place? Why does the Treasury issue bonds at all? Why don't they just say, we want to spend $6 trillion this year and we only have $3 trillion in tax receipts? Why don't they just print up either, literally or electronically, the equivalent of $3 trillion new dollars and just spend those in the economy? And then there's no debt, no interest payment. Why don't they do that? Wouldn't that achieve the objectives of the spending without the pain of rising interest costs? And then people couldn't be freaking out about the debt loads. Well, the obvious answer is, if they did that, then that would cause consumer price inflation. If just every year on net, the deficit, meaning how much the government wanted to spend minus how much they took in tax receipts, if they finance that not by borrowing the money from the public sector, the private sector, I meant to say the public, but instead just by turning to the printing press and creating the new money, well, then that would be a massive influx year after year of boatloads of new money. But probably more relevant once people saw that that's how the game was going to be played now, they would update their expectations and people would realize, whoa, I don't want to hold US dollars anymore or US dollar denominated assets. And so there would be a flight to get rid of it. And that would immediately cause a crash in the dollar. Okay, so again, what I'm explaining is, even though right now the Federal Reserve has the ability to create legal tender money, and after 1971, there's no constraints really in terms of technical constraints, whereas before, the U.S. government was obligated to redeem dollars at the rate of $35 per ounce of gold. Ever since Nixon famously closed the gold window in 71, that hasn't been a constraint. But it's wrong to say, or would be wrong to say, therefore the Fed can create as much money as it wants and there's nothing holding it back. Because if it overdoes it, that leads to unacceptably high consumer price inflation. So notice the 1970s were the period of the worst U.S. peacetime price inflation in its history. It's not a coincidence that it happened right when they untied the Fed's hands by severing the link between the dollar and gold in 71. That's why you had the stagflation of the 70s. And it got so bad, in the late 70s, the inflation rate. Okay. Back during the COVID years, consumer price inflation was the worst it had been since the early 80s. And if you go look at the money statistics, you'll see the Fed pumped in a boatload of money in 2020 and 2021. So it's not shocking that, oh, geez, everything's getting real expensive. Now, yes, that interacted with supply side bottlenecks, and economists argue about the relative contribution, but prima facie, the Fed opened up the monetary spigots during COVID and prices kept going up and up. And the economists saying, don't worry, this is just transitory. They kept having to say that, and eventually they threw in the towel and said, okay, it wasn't, just transitory. Sorry. All right. So that's what would happen. That's the ultimate reason politically the Fed doesn't just monetize all the deficit spending right now. Because if it did, the dollar would crash. All right. And, eggs would be $20 a pack. Okay. So now that you see that and realize the extreme case, like why they can't just get rid of borrowing altogether, given that they want to spend more than they can take in tax receipts, you now understand, okay, so if they do get into a crunch and they're saying, yeah, we've raised taxes, we don't think we can raise taxes more, and interest rates start rising on government debt, and they're short and they owe a bunch of bonds are coming due and they owe whatever, $50 billion in a short time period, and they don't see how they're going to raise it because they think if they try to just borrow it and roll it over, the auction's going to fail, or they would have to raise interest rates, yields on the new debt higher than they can afford because you're just looking at, no, we're getting squeezed. Already the interest expense is way more than we can handle. We can't borrow at an even higher rate in order to keep this going. That's just making the problem worse for us, a year from now. We got to do something different. And then they say, well, we could just ask the Fed to monetize it. That would keep rates low, in other words, right? Like if we have the auction, but we assure the primary dealers and we all know it's all worked out that the Fed is going to buy it. Or maybe the Fed does it first. The Fed comes and buys $50 billion worth of bonds to take them off the books of the private sector. So then when the Treasury issues the new $50 billion, it's kind of replacing that. And that would suppress the yields. But what if consumer price inflation is running at 6% and people are outraged about how expensive gasoline and eggs are? And, and then there was just a midterm election and the incumbent party got crushed because everyone's complaining about inflation. Well, it's not obvious that that's a good solution either in that scenario. And so you can imagine them deciding, no matter what we do, it's going to be painful, but maybe what we do is we tell these people that, the 50 billion is coming due over the next few weeks. We just tell them, sorry, we're going to, we'll get square with you 6 months from now. Don't worry, we're going to still pay you the interest that's going to accrue, but we don't have it right now. It's not impossible that could happen and that would be the outcome of the various political factions arguing about what to do, given a scenario where, like I said, yields are rising, making the interest payments on the debt a very large share of total federal spending, and that consumer price inflation is already running at levels that the public is outraged about. And in that scenario, you could imagine them partially defaulting on existing Treasury debt. That's not impossible. All right. With that, I will wrap up. So I'm not predicting Armageddon next Thursday. But what I am saying is the long-term trends are very bleak. I'm not surprised Moody's downgraded. I'm surprised it took them this long. And at some point, this cannot continue. And it's better for the ratings agencies, as they've been doing, to start to acknowledge reality and let people know that at some point this has to stop. And unfortunately, the one prediction I am comfortable making is I don't think the people in Washington will turn around the fiscal position until a crisis forces them to. That there was a brief period when Trump first came in the second time around and Elon was doing his Doge and all that. There actually were a few weeks there where I thought we might see some massive reductions in government spending this year. I didn't think it'd be enough to change the trajectory on those CBO charts, but I did think we might actually see, and now we realize, no, we won't. And that also may be partly why Moody's did the downgrade when they did, that they saw, oh no, even with this tough talking new administration that are doing all sorts of quote crazy things, like talking about eliminating the Department of Education, they're still pushing through a new spending package that is going to blow up the federal debt even more. So I think that's where we are. All right, folks, thanks for your attention. See you next time.